In business news at this hour, we extend our conversations around the expected decision on interest rates following record high consumer price inflation. As highlighted in the StatsSA figures from yesterday, South Africa's CPI has further surpassed the Reserve Bank's 3 to 6% target range in June due to the continued rise in fuel and food costs. Now, as a result, a market consensus is that the outcomes of the Central Bank's Monetary Policy Committee later today will be that of yet another 50 basis point increase in the repo rate, while some economists predict an even higher hike. Economist at FNB Koketso Mano joins us virtually to expand on this discussion. Koketso, thank you so much for your time. There's talk of either a 50 basis point hike or 75 and even that 1%. What's your take?
Yeah, thank you for having me. So at FNB, we currently expect a 50 basis point hike this afternoon. We think that the MPC will be facing quite a bit of a policy dilemma. As you've mentioned in your opening remarks, we are seeing quite elevated inflation at the moment, but there are rising growth concerns with rising interest rates globally. Global financial conditions have started to tighten. We've seen elevated inflation in the US as well, and that monetary policy authority has been hiking quite aggressively and is expected to continue to do so. So these growth concerns are also going to be a feature in the Monetary Policy Committee's decision, and but we think that they'll be firmly focused on the primary mandate, which is to maintain inflation within 3 to 6%, preferably 4.5%.
And you mentioned that global monetary policy is being tested with the current economic times. What I've found interesting and would like to pick your brain on is how South Africa needs to really be on par with the rest of the globe. We are seeing tightening in the likes of the US as well as the UK. But at the same time, if South Africa does not stay on par with the rest of the global MPC decisions, it means inflation is still going to go up anyway. So where then does the Reserve Bank find a balance?
Yeah, it's a tricky one because the Reserve Bank does not follow, what the US or what trading partners would be doing with their monetary policy step by step. But it is very important consideration in the monetary policy decision making because, as you would have seen, tighter monetary policy in the US, growing growth concerns globally have resulted in the dollar in particular becoming stronger or more attractive to investors. And the strengthening in the dollar has obviously resulted in a weaker rand. If monetary policy in the US continues to be quite aggressive as we expect it to be, that will only provide further strength for the dollar. So what happens to the rand in that situation is that we continue to see weaker rand dynamics that increases our import bill, for example, especially for something that we're already feeling the pinch at the pump, which is petrol prices. And those prices are expected to go up if that continues, and if the Brent crude oil prices do not continue to fall as they have been in the recent weeks. And if that happens, obviously, then that filters through to our inflation story once again, as I mentioned. We'll continue to see elevated inflation. And I think when we go back to what I mentioned earlier, which is the primary mandate of the Reserve Bank, this is going to be a very important consideration. Think about it in this way. They also track inflation expectations, whether surveyed or market-based. They look at that and it filters through to the transmission mechanism, which is about 2 years. So if they allow these inflation expectations to continue to increase in line with elevated current inflation, what happens is that over time, you tend to see structural inflation in the economy lifting as people seek higher wages to compensate them for inflation, as businesses seek to increase prices that they pass on to consumers to compensate them for the higher prices that they also have to absorb. So the MPC has made it clear that they prefer inflation in South Africa to be around 4.5% over the long term, and I think they'll be firmly focused on that and make sure that their monetary policy is in line with this endeavor.
So all South Africans are feeling the pinch in terms of the high cost of living. And we saw that in the CPI data from StatsSA yesterday. An increase of over 8% when it comes to food and fuel is staggering. But I'm interested in finding out then what the impact of this climate is on the South African consumer, especially because the outlook is of further interest rate hikes as inflation continues to rise.
Exactly. And just to touch on further interest rate hikes, I mean, we see the 50 basis points today. We see another 50 basis points in the September meeting, and then another in November. So that would bring interest rates at the end of the year to 6.25%. That is a repo rate. And I mean, other analysts see it going up as high as 6.75%. So that would mean that the interest payments on loans, on credit, will have to also be taken into consideration when consumers look at their household budgets. I mean, this is adding or compounding to higher inflation. Potentially, if you don't get the type of wage increase that you're seeking to compensate for inflation, then that means that your disposable income is falling or your real income is falling. So consumers are going to essentially feel the pinch. But what we are seeing in our credit data, and also the Reserve Bank has also published credit data from their side as well, is that credit demand remains fairly robust. I mean, if you think about credit for vehicles, credit for mortgages or houses, that has been quite strong and resilient. And it might be a feature of, people still taking advantage of lower interest rates relative to history. It may be a better balance sheets following the pandemic. It might be growing non-labor income, which is dividend income with higher commodity prices. But we are seeing that credit demand remaining fairly strong. The consumer in general has remained fairly resistant during this time, but we don't expect this to continue for much longer with high interest rates. But it is quite interesting that to date, the consumer is looking quite strong actually.
That's an interesting one, and that latter word of resilience keeps proving itself with the South African consumer. But as you rightfully mentioned, that the disposable incomes of South Africans are diminishing. At the same time, we know that the salary packages are not going up. So for the South African consumer, for how much longer really is it going to be a climate that is not favorable for our day-to-day living costs?
Mm-hmm. Is that a question?
Yes, it certainly is, because, I mean, I fully understand your expression there, because you and I are in the same boat. I mean, we are all South Africans like everyone else watching right now. And the biggest question that we usually get, and that's the reason why I ask that question about sustainability of resilience amid the cost of living that's rising, is there no other way of tapering inflation as well as making sure that the consumer is taken care of?
Fair. All right, I'm with you. And I do agree. I mean, there's a lot of compounding pressure on the consumer. And I think one other thing to mention is we are seeing in the next CPI data, the increases in electricity that have come through at the start of July, higher utility rates, and we've seen already some protests around that. So it is evident that a lot of consumers are feeling the pressure. And I think if you think about your lower income bands, I mean, those consumers are facing inflation of around 9.1% with this elevated food inflation dynamics. So, I mean, it's different across, I think, different income groups. So lower income groups would probably already be feeling quite a bit of the pinch. Meanwhile, your middle to higher income groups will also start to feel the pinch as more of these inflationary pressures come through, as more of their credit interest payments lift. So I think in the near term, which is up around a year from now, we would really start to see, over the next year, we would really start to see the consumer starting to feel the pinch, maybe pulling back on the credit demand, pulling back on some of the discretionary spending. But I think what also is important to mention is that, with lower growth, which is what analysts are starting to grow concerns about, you do generally start to see demand falling, consumer demand in particular. But at the current moment, the reason the MPC has to continue to lift interest rates is because unfortunately, inflation is not necessarily demand-driven. It has been supply-side driven. So we have been seeing higher fuel costs, higher food costs, and those have an impact on how, as I've mentioned earlier, inflation expectations are likely to evolve. So while you do expect to see growth moderating over the near term, we also had the KZN floods in the second quarter, so that would affect that number, load shedding as well. But we still have this supply-side driven driven inflation dynamics that are expected to filter through to how consumers and businesses are making their wage and price decisions. And it is important for the MPC to make sure that inflation expectations do not de-anchor from the 4.5%. In the previous survey by the BER, we did see those inflation expectations lifting from 4.5% to 5%. And this is something that the MPC has been working towards for quite some time, bringing those inflation expectations to 4.5%. So seeing them de-anchor or moving away from that figure is going to be quite concerning from the MPC. And I'd like to mention that we get another survey data point today from the BER that will also once again tell us what households and businesses analysts are filtering through with the currently elevated inflation.
We'll leave it there with Koketso Mano, economist at FNB, talking to us about that expected interest rate hike. At 3 p.m. is the time where we'll get an address from the Reserve Bank.